Welcome everybody to our third quarter 2021 market update. Bob and I will share with you our thoughts on where the market is right now, where we think it's going. Our agenda is simply this. It will be much shorter than this looks. We won't take that much time, but we'll talk about our current allocation and our performance so far, evaluation of the markets, talk a little bit about bonds as well. With that, I'm going to pass it over to Bob, and you can start out, Bob, talking about our current allocations and long-term strategic plan.
Sure. Thanks, John. So, from an investment standpoint, there's times as an investment manager, we look at everything and we try to decide what we really like the most. And then there's other times like these where we try to decide what we like the least. And this is more of those times here. We continue to be very strongly overweighted all domestic stocks. We have no international exposure at all. And a big piece of that is not only is the U.S. economy doing far greater than the international economies, the U.S. dollar continues to strengthen. So, which inversely is going to mean that their currencies are weakening. There's really been dramatic outperformance by keeping ourselves overweight to the domestic stock space. And we've also shifted that. We had a really aggressive overweight to small and mid coming out of the pandemic. They were undervalued, and those early cycle economic growth stocks tend to do very, very well, and they did. They performed outstanding during that period. And then lastly, on the bond side of things, it is getting more difficult. Spreads continue to get tighter. Credit spreads continue to get tighter. We have our overweight to government bonds, which extends our duration or interest rate risk. It's a funny way to think about things, but the way we think about that is this allows us to take on more stock risk, and we're really concerned that we're going to see meaningful pullbacks in the stock market. While we still expect stocks to be go up longer term, these meaningful pullbacks, we want this duration to sort of cushion the path of the overall portfolio returns during that time. So here are the year-to-date numbers. We talked about small cap up 23%. The other end of that, your bond, they're not doing anything wrong. They're just not doing anything right. There's just not a lot of yield in them. The 10-year, I believe this morning when I peeked at it, was at 1.19%. I mean, you're only going to make so much money off of that, and it's hard for those yields to go lower and push prices higher at those lower rates. But you can see, Asian equity and European equity, which we've kept the bond our investors completely out of, have really dramatically underperformed. So it's been certainly on the year to date, and then you go out to the 1 year, it's even more dramatic there. Here's one of our challenges that we look at right now. This is our valuation. And when we look at valuation, we look at a lot of the price to earnings ratios. At some level, all investors are buying earnings. That's what when you buy a stock, you're buying that company's earnings, whether they pay it out as a dividend, whether they keep as retained earnings, and ultimately goes into the price of stock. That's what you're buying. They're extended right now. It's small cap, mid cap, large cap. They're all a little bit extended right now. Not dramatically, but a little bit extended. The reason why we continue to believe that that's okay at some level is that interest rates and inflation are very low. So those future earnings do deserve a higher multiple because those higher multiples are discounted at a lower rate. The second is that there's really no other place for investors to go with their money right now. There's not really any other alternatives. If you want to get, bond yields are extremely low. International stocks aren't attractive, so it's kind of by default still the best asset class out there. That's where we're keeping investors. On top of that, as we come out, this is Q1 earnings. Actually, Q2 earnings aren't official yet, but they're you see Q1 earnings year-on-year growth 48%. That's just an absolutely insane number. Q2 earnings look like right now they're coming in at a 69% year-on-year growth rate. Now, obviously, there's a large base effect there. A year ago, we were at the depths of the pandemic. We're coming out of that. But make no mistake about it, the amount of liquidity pumped into this system between the Federal Reserve System and our Treasury system, just simply sending out money to people, has created unbelievable demand. I'm sure everybody watching this has their own anecdotal stories about the crazy demand they're seeing, whether it's for cars, whether it's for rental houses, whatever it is. There's just enormous demand out there right now, and that is really driving earnings up. We mentioned 10-year Treasury bonds, or bonds in general. Rates are extremely low. They're extremely low relative to inflation, actually, at this point. A big piece of that is the Federal Reserve continues to purchase $120 billion worth of bonds each month. Each month they're doing this, and that is pushing bond yields down. So until they're, a lot of people say, well, they're artificially low, and we agree, they're artificially low. But it doesn't matter whether they're artificially low or naturally low. If they're going to remain low through these purchases, then that's going to be very stimulative for the overall economy. In high yield bonds, again, you're offered a credit spread to take on the risk of a corporate bond versus a government bond. These spreads are very, very narrow. That's one of the reasons why we're underweight the high yield a little bit right now. How much risk do you really want to take for what's really only a couple hundred basis points or 2% of additional return on spread? It's really not worth taking on that credit risk right now. So we're lightening up on both investment grade and high yield credit exposure. Muni bonds, we've been recommending against muni bonds for a long time. We really don't use them a whole lot. You can see right now they're yielding less than 1%. It's great that it's tax-free, but making less than 1% in a 2% plus inflation environment is not a good investment strategy.
So with that, Bob, I'll close it out and just let everybody know we're keeping a very close eye on the markets. We do think at some point this may end up being bad for the markets, but we're a ways off. So we're going to ride this out a little bit longer. As soon as the Fed starts to threaten action a little bit more serious, that's when we may look at making the portfolios a little bit more conservative. But at this point, we're sticking to our models and going to ride this out for as long as we can. So appreciate your time. Anybody has any questions, feel free to call anytime. Have a great summer.
Have a great summer, everyone.